It feels like the calm after the storm, as a ceasefire between Israel and Iran seems to have calmed nerves in the markets. But what does the week ahead have in store for us? Thank you for joining us at xn.com. It's the week ahead. I'm Cristina Marujos, and with me today is Haralambos Pissouros, our senior market analyst. So, Haralambos, the ceasefire eased concerns of further escalation in the Middle East, which brought down oil prices. The stock market rallied, but the U.S. dollar is at multi-year lows. So, what does this tell us about the overall market sentiment?
Hello, Christina. The market response to the Israel-Iran conflict and the reaction to the ceasefire give us some important information about investors' behavior. First of all, the main mover was oil, whose price skyrocketed on concerns about supply shortages as Iran threatened to close the Strait of Hormuz, through which nearly one-fifth of global consumption passes. Now, after the ceasefire announcement, oil prices tumbled sharply, although there were some violations of the ceasefire agreement. That said, the accord was respected the last few days. Now, as far as equities are concerned, Wall Street pulled back amid risk aversion, but not significantly, while the rebound after the truce was steeper and larger than the conflict-related pullback, which indicates how willing investors are to increase their exposure on stocks. Maybe they are still seeing future growth opportunities in tech firms, especially when it comes to artificial intelligence. Now, as for the US dollar, its tumble to multi-year lows confirms the notion that it has been the safe haven of choice during this turbulence. It gained ground while the war was raging and pulled back after the truce. Gold, which is a more traditional safe haven, was not preferred this time.
Now, Haralambos, let's turn to the upcoming week's events. A few days ago, President Donald Trump attacked Fed Chair Powell again, arguing for lower interest rates. However, the Fed is still mindful of incoming data in order to decide its next policy move. So with that in mind, how might this week's ISM PMIs and, of course, the all-important Nonfarm Payrolls report shape rate cut expectations?
Indeed, we had fresh attacks by President Trump on Fed Chair Powell about not cutting interest rates, with a Wall Street Journal report noting that the US president is considering announcing Powell's successor by September or October. This has raised concerns about the credibility and independence of the Federal Reserve and prompted investors to add to their rate cut bets. According to Fed Fund futures, market participants are now penciling in almost 65 basis points worth of rate cuts by the end of the year. The first quarter point reduction is more than fully priced in for September, while the probability of a rate cut as soon as in July has risen to 25%. So, with all that in mind, as they try to better assess how the Fed may navigate monetary policy, investors are likely to pay extra attention to the ISM PMIs for June, and that come out on Tuesday and Thursday, and also the NFP report for the same month, which is also scheduled to be released on Thursday, as on Friday in the US we have the Independence Day. Now, this week, the preliminary S&P Global PMIs came in higher than expected and showed that price pressures rose sharply in both the manufacturing and services sectors. So, should the ISM reports paint a similar picture, investors are likely to scale back their rate cut bets, especially if non-farm payrolls continue to indicate that the labor market is doing relatively well. The US dollar is likely to rebound as the market becomes more accustomed to the idea that the Fed could remain patient before resuming its rate cut process.
And now let's cross into Europe. We'll be getting CPI inflation data from the Eurozone this week. Now, could this data set corroborate further European Central Bank rate cuts? And if so, where would that leave the euro?
At the latest gathering, the ECB decided to cut interest rates by 25 basis points, bringing the deposit rate to 2%. With President Lagarde noting that they are in good position with the current rate path, and investors, I believe they translated that statement as increasing the likelihood for a pause in rate cuts, for a break. Now, since that meeting, GDP data revealed higher than expected growth for the first quarter, while retail sales for April accelerated instead of slowing as the forecast suggested. This corroborated the idea that the ECB could be a bit patient for now. However, the tumble in industrial production and the weaker than expected PMIs for June keep the door wide open for at least one more rate cut, even if it is not delivered in July. According to money markets, investors are fully penciling in one last quarter point reduction by the ECB in December. Now, with the headline CPI rate slipping to 1.9% year-on-year in May, which is a tick below the ECB's objective of 2%, investors are unlikely to change significantly their view, even if inflation accelerates somewhat. I believe that instead of expecting the next rate cut to be delivered in December, they may just push that timing into the beginning of 2026, something that could further support the euro.
I see. Ana Lambos, thanks so much. This was The Week Ahead here at xn.com.